Zach's Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. When you say, "let me check my calendar," and use that phrase in the same sentence as options or options trading, you know the two are connected, at least when it involves Kevin Matris, who is our top options guru here. And it generally involves something called calendar spreads, unless I miss my guess here. Bet you thought I was going to say calendar girl.
Yeah, darn it.
So tell me here, could you be talking about calendar spreads? I've heard about this before.
Yeah, it's funny because a lot of people, you know, whether they even know anything about options or not, a lot of people have probably heard of somebody use the term calendar spreads or something like that. Whether they knew what they were talking about is a completely different story, but that is what we're going to be talking about today.
So what are they?
All right, check it out. A calendar spread, also known as a time spread or horizontal spread, is when you sell or write an option in 1 month and then you buy an option with the same strike price but in a different further out month. Since the option you're writing has less time, in other words, it's worth less, and the one you're buying has more time, it's worth more, this can also be referred to as a debit spread as well because you're actually paying money to put this trade on.
Okay.
You can also do this with puts as well. You can sell a put in a nearby month and you can buy the same strike in a further out month. And as you would expect, if you're doing this with calls, you have a neutral to bullish bias. If you're doing it with puts, you have a neutral to bearish bias. Now again, you can also sell this strategy as well, and the way you would do this is you would buy the nearby and sell the further out, but for this piece we're going to focus in on the long side.
Okay, so elucidate on this for us, Osage one.
All right, check it out. Let's use IBM as an example. All right? Let's say you wrote the July 130 call for $3, which means you'd be collecting $300. Let's also say that you bought the October 130 call for $685, which means you paid $685.
Okay.
Your net cost or debit is $385 or $385. So the one question is, why would I want to do this? First off, your maximum potential loss is limited to what you paid for the spread, which in this case is $385. The maximum profit, if you remove both positions at the same time, once the options expire, your maximum profit is the difference between the two options at the expiration of the nearby month. So let's continue with this example.
All right.
At expiration, right, of the July options, the July 130 call I wrote for $300 is now worth $0. And the October 130 call I bought for $685 is now worth, let's say, $560. So my calendar spread is worth $560. 560 less my cost of $385 equals a profit of $175 or a 45% return. Now, if I wanted to, I could actually continue to hold on to that long call because I have plenty of time left. If I thought the IBM or whatever stock I was in was really getting ready to rally even more, I could hold on to that and I could increase my potential profit. However, though, if I held on to that option and the stock went down, of course I could lose, what's left in my position. But the real benefit, though, is that under the worst case scenario, I could never lose more than what I originally paid, which was $385.
So is this as easy as it sounds?
It really is. It's a very simple strategy. I believe it's a highly profitable strategy. And what's interesting is that it is true that you are limiting your profit potential, but you're capitalizing on one of the dynamics of options, which is the nearby month will see its value deteriorate quicker because of the decreasing time value, and it does so quicker than the further out one. So instead of being a victim of time decay, you're actually benefiting and taking advantage of this time decay. What's interesting, though, is that some people will not look at this strategy because they think to themselves that the returns are kind of small. You talk about $175 or $200. But if you look at it in terms of percentages, 30%, 40%, or in this case, 45%, I think that's pretty good. So if you put 10 of these positions on, for example, your outlay, excluding commissions, you'd be investing $3,850. But if you made $175 on 10 positions, that's $1,750. That's a 45% return, and I think that is pretty exciting.
All right, if you need to help yourself visualize this more, and you're not on Zacks.com right now looking at this video, go there and scroll down the page till you get to the options section, and that is where you can link to a text version of this entire explanation that Kevin has just expounded on here. And sometimes it helps to see it in writing and go through it point by point that way. With Kevin Matris giving you more information to know your options, I'm Terry Ruffalo.